In this video, I will explain the difference between accounting profit, economic profit, and normal profit. The concept of profit itself is rather straightforward. It's simply the difference between total revenue and total cost. Total revenue is simply the market price multiplied by the quantity of the good or service that has been sold by a particular company. However, the concept of total cost is a little bit more ambiguous or complicated to define because there are two different types of costs. On the one hand, you have explicit costs, which include all payments to the factors of production. So, for example, wages to employees, the cost of purchasing raw material, the cost of renting a machine or a building. So anytime you need to take out your wallet to pay something, then this is an explicit cost. An implicit cost is a benefit that you give up. So in the context of production, let's say that you want to start your own business and you choose to use a building that you own as your headquarters. Then in that case, you give up the possibility, the opportunity to rent this building and to receive money every month. Another example, to better understand the difference between an explicit and an implicit cost, let's assume that you are a cab driver. You are a cab driver and this is not your lucky day. Your car has some kind of incident or problem, so you need to take your cab to the garage to get it fixed. And the problem is that you cannot work for 2 days because you have to wait for the people in the garage to fix your car. Well, of course, this incident will generate explicit costs. The cost of fixing your car, you need to pay the workers of the garage, but it also entails an implicit cost in the sense that you were not able to work for 2 days, and therefore you have lost the income, the wage that you could have received if you could have worked during those 2 days. Okay, so I think that now it's clear what the distinction is. So the first way to define profit is to take into account only the explicit cost. This definition is known as we define accounting profit. So accounting profit is total revenue minus total explicit cost. So we leave implicit cost aside. The only small detail that you have to take into account is that the accounting profit also includes depreciation. Depreciation does not directly qualify for being an explicit cost, but accountants do take into account the loss in value of physical capital. So just keep in mind that it is included in accounting profit. Then the broader definition of economic profit consists in taking into account all costs, both explicit and implicit costs. So economic profit is just basically total revenue minus total cost, both implicit and explicit. Another way to put it is to say that economic profit is just equal to accounting profit minus implicit cost. So if we look at this formula, it follows that the economic profit will always be smaller than the accounting profit. Normal profit is very different. Normal profit is a cost, and this is really the bottom line of this video. This is really what I want to emphasize. Normal profit is a cost. To be more specific, it's an implicit cost, and it's the implicit cost associated with the use of one type of factor of production, entrepreneurship. So the idea here is that if you are an entrepreneur and you have to decide what type of business you want to carry out, let's say you have business A and business B. If you choose to carry out business A, then you give up the profit that you could have made by running business B. This is normal profit, the implicit cost of entrepreneurship. And you know that, and this is what I will explain in an example in a few minutes, that when a firm makes and this is the keyword here, I'll explain later, makes abnormal profit, which means when the firm makes more than normal profit, then its economic profit is strictly positive. When the firm makes subnormal profit, less than normal profit, then the economic profit will be negative. And when the firm makes exactly normal profit, then its economic profit is equal to 0. So this is what we learn in economics textbook, but to be frank, it never really made sense to me. This concept of making, what does it mean to make abnormal profit, to make subnormal profit, and what is the relationship between normal profit and economic profit? This was never very clear to me. So what we are going to do now is to use an example in order to better understand the meaning of those three statements. So let's take the example of a farmer who owns a field and who owns some capital equipment. This can be a warehouse, a tractor, it doesn't really matter. And this farmer has to decide what he's going to grow. And we will assume that he has two alternatives. He can grow potatoes, that will be business A, or he can grow corn. This is going to be business B. So what this farmer does is he's doing some market research in order to estimate the price at which he could sell his corn and potatoes. But you know that this is mostly a market that is close to perfect competition. So the farmer is likely to be price taker, and the market price is likely to be easy to compute or to anticipate. So basically, the farmer just has to, compute how much output he wants to produce, or to determine how much output he wants to produce, and he will get the total revenue. So let's say that he anticipates he can get $12,000 as total revenue if he grows potatoes, and he could make $20,000 of total revenue if he decides to grow corn. So apart from computing its total revenue, the farmer can also compute his cost of production. So the first type of cost of production is what we call intermediate consumption, which refers to the purchase of goods and services from other companies. So in the case of this farming activity, the farmers might have to purchase seeds, fertilizers, and so on to other companies. So we have this first cost of production, of course, for business A and for business B. This farmer might also need to hire some farm workers. Maybe he needs some help to be able to carry out this production. So there will be some labor cost, wages. So same thing for business A and for business B. Also, it's clear that I said that this farmer owns the field, but it does not mean that using the field is free. Nothing is ever free in economics. So in this case, using the field will entail an implicit cost, in the sense that when the farmer chooses to use the field to run his own business, then he gives up the opportunity to rent this field and to receive money in return. So the $2,000 that we have here could be the rent that he could have received if he had decided to rent his field rather than to use it himself. So in this case, it's the same for business A and business B. And likewise, this farmer has some capital equipment, a warehouse, a tractor, and for the same idea, for the same reason, when this farmer chooses to use this capital equipment to run his own business rather than to rent it, there will be an implicit opportunity cost. This farmer could have received $2,000 from the rent of the warehouse or the tractor. So of course, it's the same thing for business A and business B here. And we have the value, the depreciation, which is the loss in the value of the capital equipment. Okay, so what we are going to do first is to compute the accounting profit for both businesses. So remember, the accounting profit is just the difference between total revenue and total explicit cost and depreciation. So total revenue is right here. What is an explicit cost? Intermediate consumption, of course, it is an explicit cost. I have to pay the other companies. Wages, it is an explicit cost. But however, those two costs here are obviously implicit costs. And remember, when you compute the accounting profit, you take into account depreciation. So basically, my accounting profit will be 12,000 minus 2,000 minus 2,000 minus 1,000. This should be $7,000. Same thing for business B, so I'm not going to detail its exact same calculation. So the accounting profit is lower in this case. Okay. But this is not my economic profit. How do I compute the economic profit? I can start from this accounting profit and subtract the two implicit costs that I have here. The implicit cost of using the field and the implicit cost of using capital equipment, which means that I will subtract $4,000. Is this going to be my economic profit? Not exactly. I will explain this in a minute. Let's just call that gross economic profit. And same thing here, I subtract $4,000, the two implicit costs. Let's call that gross economic profit. So maybe you are going to ask me, yeah, but why do I need to distinguish economic profit from gross economic profit? Well, the reason is that I have not subtracted all implicit costs yet. In this case, I have subtracted the implicit cost of the land that I use, the implicit cost of the capital equipment that I own and that I use, but there is something that I have not subtracted yet. It's the implicit cost of entrepreneurship. And what is it? It is the profit that I could have made when running my next best alternative. So for example, if I run business A, if I choose to grow potatoes, then I give up the profit that I could have made when growing corn instead. And what is the profit that I give up when I grow potatoes rather than growing corn? I give up this gross economic profit of $2,000. In other words, the implicit cost of entrepreneurship when this farmer chooses business A is equal to $2,000, the normal profit, which is the gross economic profit of business B. What I give up, the profit that I give up when I choose to grow potatoes. And I can do exactly the same thing for business B. Let's assume that this farmer chooses to grow corn rather than potatoes. Then in this case, this farmer gives up the gross economic profit that he could have made when growing potatoes. So the normal profit when the farmer chooses to grow corn is equal to $3,000, the gross economic profit of business A. So then, now that I have the normal profit, okay, so I have the gross economic profit when I grow potatoes. If I subtract the normal profit, then I will get, I don't need this anymore, economic profit. Economic profit is the $3,000 minus the normal profit. And in this case, what do we see? We see that the firm makes more than normal profit. The firm makes abnormal profit. $3,000 is more than $2,000, and therefore the economic profit is positive. But if we look at business B, the firm is making less than normal profit, and as a result, economic profit is negative. $2,000 minus $3,000 is equal to minus $1,000. So then the last question that we can ask ourselves is, well, what should the farmer do? Of course, in this case, he should grow potatoes. Growing potatoes provides a positive economic profit, which means that this is the best alternative that the farmer can choose. This is the best option. And of course, business B yields a negative economic profit, which means that if the farmer is currently growing corn, he should just stop and instead grow potatoes.